welcome. I'm excited to get started with our topic on consumer loans, specifically personal loans, and how to use them to your favor. I'm Becky Freemall here at ValleyStar Credit Union, and joining me today is Brad Hudson, Vice President of Consumer Lending at ValleyStar Credit Union. Hey, Brad.
Hey, Becky, thanks for having me on.
Hey, thanks for joining us. I gotta dive right into this first question, which is, I've done a little research and I know you have quite a few credentials to speak on the topic of consumer loans. So before we get into it, if you could, just for the listeners, share a little bit about yourself and your consumer lending background.
Yeah, Becky, I appreciate that. So I'm about 27 years in the credit union industry. The whole time that I've been in the credit union industry, I've been involved in loans. I was fortunate enough to where I started out on the ground floor working with members on their lending needs, and then was able to work my way up the ladder to where I am today as Vice President of Consumer Lending. So I come with a great deal of knowledge and experience, and I'm hoping to put that to use for ValleyStar and our members of ValleyStar.
Well, I appreciate it. And you're going to put it to use right now, because I'm going to ask you all sorts of questions for those who are listening in and for my own knowledge, to be completely honest. So here's my very first and very simple question. And it seems rudimentary, but there are some aspects to it that you can kind of help add some nuance, which is, what is a consumer loan?
Consumer loan can range in a couple different scenarios, but what it boils down to is, what is the purpose of the loan? Lending is usually defined in one of two ways. It's either commercial lending or it's consumer lending. So what is the purpose of those funds? So if you're using it for any kind of commercial use, that would be considered a commercial loan. Personal loans typically are individual based for personal use, whether you're using it to pay off some credit cards or to get your car repaired or whatever the case may be. It ranges from mortgages to credit cards to personal loans to vehicle loans, all fall under consumer lending.
Okay, so there's secured and there's unsecured loans. We hear that getting thrown around in the financial world quite a bit. So what exactly does that mean for me when I'm going out and I'm looking for a loan and I hear unsecured and I hear secured and my head starts to spin? Unspin it for me and explain.
No, that's a good question, Becky, and I appreciate you asking that. So basically, when it comes down to secured versus unsecured, securities usually has an asset tied to it. So whether it's a savings account or a car or a home, something is tied to that. An unsecured loan, there is no asset tied to it. It is unsecured. There's no collateral. The benefits of being able to do a secured loan versus an unsecured loan as a consumer comes down to is what rate of interest that you pay. Rates are set based on risk tolerance of financial institutions. Unsecured loan, because there is no collateral or a higher riskier loan, therefore a higher interest rate. So as a consumer, you would pay higher finance charges, higher APR, and so forth.
Talk a little bit, if you would, specifically about personal loans. And you did kind of touch upon this a little bit before when I just asked about consumer loans in general. But when you're talking about all those different loans, where do personal loans fit in when it comes to all the boxes that you might check? Like how long you have to pay it off, how much the interest might be, like how does it compare to all the other loans?
Yeah, so personal loans basically are an amortized loan, an installment loan where you have a fixed.
Okay. I'm going to cut you right there. When you say amortized, what the heck are you talking about? I'm going to stop you there, Brad Hudson. What do you mean by amortized loan?
Well, not amortized, amortized. So amortized, basically, it's a fixed period of time. So think of, you borrow a set dollar amount for a monthly payment over an interest rate. Every month you have a payment. So that is called an amortization schedule. Each monthly payment shows that if it were on a piece of paper or something like that. So that's what I mean by an amortized loan. It's a fixed interest rate with a fixed payment, basically a fixed installment plan over a certain period of time.
All right, listener, you're welcome. I'm hooking you up, listener. Brad's throwing all his financial knowledge out.
I'm sorry about that, Becky.
I'm joking.
So typically speaking, a personal loan is unsecured. Okay. It depends on what your consumer needs are. If they're short term, you might want to go a quick unsecured loan because you're not going to keep it for very long and they're not going to have to pay that much interest. Depending on what your needs are, if you're wanting to consolidate some debt or if you're wanting to get your car repaired, different things like that. So it can be all over the board depending on what the consumer's needs are. But typically they are an unsecured loan, shorter term, higher interest rate.
When it comes to personal loans, what kind of credit does a person need? We all know you have to have good credit report. where does this fit into all of that? And when is it a good idea to get a personal loan? Because my fear also is what happens if you get it and it dings your credit score? I don't know if it would, but
It absolutely would. And I'll kind of explain some of that to you. So this obviously is going to vary from financial institution to financial institution, depending on who you're dealing with, as far as what criteria they require. What I would tell you is, as a consumer, to put yourself in the best possible lending position, the higher your credit score, the more timely that your debts are paid, the better opportunity you have to be able to not only qualify, but be able to receive the best possible interest rate. As far as that goes. When do you get that? It just depends, again, what your needs are. What people don't understand when it comes to credit bureau and credit score, what makes up your credit score, about 35% is something what they call capacity. Capacity looks at your revolving debt balance versus your credit limit. And if you look at what your credit limit is, and the more balances you have on that, it means the higher the lower percentage as far as available, that will actually lower your credit score. So an installment loan, like a personal loan to consolidate that credit card debt, could actually improve your credit score by paying off some of that revolving debt balance and freeing up that capacity. It would actually cause your credit score to go up. When would a personal loan hurt your credit? One of the things that affects your credit score is new loans that go on the system or new loans that go on your profile. So taking out that new loan will cause you a short-term ding, but paying that loan timely, on time and over a period of time, your credit score will rebound and possibly even increase.
so it's almost like a one step back for two steps forward, as long as you
Exactly.
pay it off, like you said.
Exactly.
So when you talk about a personal loan, and there is the opportunity to get a better interest rate many times when you're looking and when you're looking at credit cards, and of course it could go the other way if you had a 0% credit card, but sometimes you might be able to get that better offer with the personal loan, but there are obviously some differences because I think people might think, well, I had a credit card, I'm fine, I'll just use my credit card, or I can just pay that off whenever I want. And this personal loan, they give me a set time. And what happens if I can't pay it off in that amount of time? And how do I do the math on it? So how does it work in regards to all of that?
Well, it's going to vary financial institution to financial institution, but what I can tell you, generally speaking, is most of the time when you're dealing with a credit card, your payment's somewhere around 3 to maybe 3.5% of whatever your balance is. That's how they come up with your payment amount every month. So it adjusts every month depending on what your balance is. Where with a personal loan, you're talking about again a fixed period of time, an installment period. You usually have a term associated with it, so you know exactly what your payment is going to be every single month. As far as that goes, the advantages of doing an installment loan versus the credit card is exactly what I talked about, the impacts to your credit score. If you have the revolving debt available to you and you use it, that's fine, but then now you're reducing your availability on your revolving balances, therefore reducing your capacity and therefore reducing your credit score. So that installment loan may work better to your advantage to be able to help in that situation. And then, like I said, the other thing is budgeting needs, as far as you know exactly what your payment is every single month and you know when it's going to be paid off. Credit card, if you typically make a minimum payment amount, you're talking about in the neighborhood of about 15 years probably plus to be able to pay that off. And that's going to vary card to card depending on what your interest rate is and what the minimum payment is and so forth. But it typically is longer than an installment period. And some people don't realize that because the payment is sometimes smaller. The recommendation is don't make the minimum payments, pay as much as possible, turn your revolving debt into installment debt, and that'll help improve your credit situation, and then make timely payments.
Awesome. All right, everybody. Brad Hudson, Vice President of Consumer Lending here at ValleyStar Credit Union. And again, I'm Becky Freemall. Thank you so much for spending your time with us. And I've got to say, I'm constantly amazed at the financial knowledge that surrounds me here at ValleyStar. Brad, thank you so much for taking time to throw some money tips our way.
Great. Thank you, Becky. I appreciate everything.
Thank you. And for those of you listening along with us, if you have any questions or you have an idea for a future financial education podcast, just let us know. You can email us at learn@valleystar.org. If you prefer to dig around yourself, you can find plenty of information on our website, valleystar.org, where we speak your language.